Wealth team of financial experts is here to answer your questions and help preserve your family's financial future. Now, you're live.
Happy Monday, everybody. Welcome to the Word on Wealth. It's good. I hope you had a great weekend. It's going to be a good week. We're going to make it so. And I'm just really happy to have you along today. We've got a couple things coming up that'll be a lot of fun. At the mid-show, we're going to have Rich Mathurin of GQ Law come in and talk about taxes. We're in tax season. You know that, right? If you have any friends or associates that have anything to do with the taxes, tax preparation, tax filing, and all that, this is go time for them. Most of the tax professional friends that I have, you don't get to talk to them a lot from about mid-January to probably mid-April. And of course, this year, because there are so many disaster zones declared in California, there's filing requirement kicks them out to May. So that doesn't help tax professionals. They're not super happy about extensions like that, because now it's not only the April 15th extension, it's going all the way to May. So watch it. Do your tax professional a favor and get in to see them early. Don't wait till April 1st. Don't wait till March 1st, which is coming up. I mean, we're a month away from the April 1st, where most tax professionals will just say, I don't want to do it sloppy. Don't want to do too fast. I'm cutting you off April 1st. That's not April Fool's Day. That's just the 1st. That's the day they're going to cut you off. So go for it. Get in there. Get your tax preparation done. If you need it done by GQ Law, we are happy to work with you. We have a professional tax preparation staff that will do it for you. In the numbers 855-500-TRUST. If you have your own tax professional, stick with them. Find out what they're up to. Help them get their job done. Get it done right, and you will be happy. A tax professional is always good. It's a good way to go. I mean, I thought I was really smart. I'm a tax attorney. I know how to do tax returns. I don't particularly enjoy it. It's not my forte. It's not my love. And when I finally got smart and hired my own tax professional to help me, it changed my life. It really, really did. It made all the difference in the world. Getting somebody to do my payroll for me, getting somebody to do my tax returns and answer all the questions and do all that crazy learning they have to do every year to make sure they got it right. So be kind. We should call this Be Kind to Your Tax Professional Month. And then we should do that next month too. Be kind to your tax professional month, because they deserve it. They work hard. The laws are insane. All the things that we have to learn as tax professionals. It's crazy. You know, they have to have like 40 hours a year of education. Some professional licenses require 30, some require 40. Attorneys, we have to get 25 every 3 years. So it's like nothing compared to that. It's incredible what they have to do. So tax professionals, they don't get paid enough. They do work really hard, and they really like your cases. So go to your tax professional. All right. But that's coming up. That's Rich Mathurin. And remember, on Wednesday, we've got Ken Peckus. He's our real estate guy. Thursday, we got Anthony Wright. He's our money guy. And then Friday, we are on to a Wealth of Joy, where we discover all kinds of things about wealth with no dollar signs. Okay. We are all into getting our trusts done. And I am so happy that I have so many of my listeners that are coming into me and saying, Gary, I think I need a trust. And I agree with them. And we go over all the options, the ins and outs, the goods and bads, the costs, the money savings, and give them the option of making their choices. We've been doing a lot of interviews, telephone calls, which are good. And if you're pretty committed to doing it, you can talk, over the phone. You want to discuss it. That's great. I really prefer in person, because we can, it's easier to describe things. It's easier to answer questions. It's easier when there's two or more of you together doing the trust. It's really easier to have, instead of two people on speakerphone, which is just clumsy anyways. It's better to have you come in, and that's what I prefer. That way I get to meet you. And you only need 2 visits. You need a first visit to figure out what's going on, and you need the second visit to do the review and signing. Some people review it in the interim, most don't. Signing takes somewhere between 30 to 60 minutes, and you are done. Good to go. There's some more work to do afterwards that we help you through. But the lion's share and the important part, the really big important part with your house and all that, that can be done within usually about a 2-week turnaround with us. So we got a good team, good setup, so we get it done pretty quickly. Of course, if you need it done faster than that, it's always possible. We just put you on the high-speed track and get it done faster, and everybody runs around and goes crazy and does your work. And we are so glad to do that. Different types of trusts. Okay, distributions. The main part of the trust, it's like blah, blah, blah. Okay, the function of the trust is that we create a document that explains what the trust is. Meaning, the trust says declaration of trust, and it says, while you're alive, the trustee is you. And while you're alive, the trustee will pay to the beneficiaries, you, anything you need and want. Okay. Phase 2. The trust says, if you become incompetent, then your successor trustee that you named will serve as your money handler and will pay to you, the beneficiary, you, all monies necessary for healthcare, education, maintenance, lifestyle, because it's your money and they're just handling it for you. And now you're incompetent, which means you may need assisted living, respite care, maybe, caretakers that come into your house or somebody to come and visit or whatever. That can all be covered by your trust under the care and watchful eye of your successor trustee. All right. Phase 3. Third part of your trust is what we all think about. You have a trust because when you die, your money is somewhere. It's either in your trust or it's not. If it is not in your trust, it goes through probate. Yuck. If it is in your trust, it avoids probate. Okay. The trust then is this thing that creates this legal condition, this legal fiction, a legal box, a legal structure that houses your personal property, which is like household goods, tangible personal property, your clothing, your money, all that stuff. It also houses your real property. That's the stuff that's attached to dirt, your home, your lot, those things. That is all your real property. That housed in your trust is now administered, governed, distributed, given away, because your trust says how to do that. And the person in charge of that is the successor trustee. So the big part then is when you pass away, money's going to be given to your beneficiaries. And the way it's given can be controlled for a long time and very precisely, or just kind of a general distribution and take no time at all. There's a trust called a disincentive trust. It's a piece that we draft into the trust where it says, hey, if the successor trustee determines that one of these beneficiaries is using illegal drugs, is using alcohol, basically is like not contributing anything, but really is kind of a lush or really is not functioning, then they can withhold distributions. They can require, first of all, they can require testing. And if they are abusing drugs, using illegal drugs or abusing alcohol, then their money that's supposed to be paid to them can be withheld until they clean it up. And that can be written into the trust. We do that quite often. When they do get cleaned up, sometimes they need money to go to rehabilitation or to have, medical testing or to, have special training and that type of thing. That can be paid for out of their money by the trustee. If they clean it up, then the trustee can make the distributions just like the trust says. So it kind of puts like a pause. It pauses any money they're supposed to be getting, whether it's payments or distributions or payouts, that gets paused during the time that the trustee determines that they are no longer, capable of handling the money or even needing it. Okay. Next thing is incentive trust, kind of the flip side of it. I want to talk about that next here on the Word on Wealth. If you want help with a trust, I'm happy to do it for you. 855-500-TRUST. 855-500-TRUST. Coming up next, the incentive trust, the opposite of a disincentive trust.
You don't need to know everything. You just need to know where to find answers you can trust when you need them. Welcome to the Word on Wealth with Gary Quackenbush. We are here to help you build, protect, and transfer everything you've worked hard for with expert estate planning, trust administration, inheritance, and probate. Call Gary and the team at QLaw.com. 855 500 Trust.
You're saving and investing for the future, and that's good. Have you ever stopped to think, where does my money actually go? This is faith-based investing with Anthony Wright.
Most Christians just don't understand that the money they save for retirement usually helps fund the abortion industry and other liberal anti-family causes. But did you know that with just a few minutes of your time, we can screen and clean your investments at no cost to you? It's absolutely complimentary. Just go to the website right now, download a free copy of my book, Faith-Based Investing. It's free as well. You deserve to know the truth as the investor. Then the choice is yours. You can keep doing what you're doing, or you can line up your investments and life savings with your beliefs. We are fiduciary investment advisors. You can feel good about investing with confidence. So learn more now. Go to BibleSafeInvesting.com or call me at 931-RETIRED. Your free book is waiting for you. Go to BibleSafeInvesting.com and be sure that you listen to Faith-Based Investing this weekend right here on Family Car.
Gary, how do you and your team help our listeners avoid probate?
Well, first of all, probate is a process that involves attorneys, judges, and sometimes contesting parties. And so we try to avoid probate at pretty much all costs. The way we do that is setting up living trusts, setting up properly documented wills, putting the property like houses, cars, bank accounts in that trust so that it avoids probate. Probate is only necessary if the estate plan isn't set up quite right. So we help them get it set up right. And mainly that's done through a properly created living trust.
Call Gary and the team at GQ Law, 855-500-TRUST, or go online and download Gary's free ebooks and videos. Read Gary's blogs. Call or click to request your free initial consultation. That's gqlaw.com, 855-500-TRUST.
Hello, I'm Garth Blumenthal, Mercedes-Benz of Temecula. And if you're less enamored with the car you drive, it's time to rekindle the flame with a stunning selection of hot new models to make your heart skip a beat. For example, lease a 2023 GLB 250 for just $539 per month, 36 months, 10,000 miles, $42.83 due at signing. Visit mbtemecula.com to shop the Mercedes-Benz and Sprinter inventory, or stop by the dealership to meet your new match.
Mercedes-Benz of Temecula, building relationships one guest at a time.
Call 844.
You're not alone. Ask for the legal help you need. Call Gary and the team at GQ Law, 855-500-TRUST, or go online and download Gary's free ebooks and videos. Read Gary's blogs. Call or click to request your free consultation or to talk with a member of the GQ team. That's gqlaw.com, 855-500-TRUST.
Okay, we are talking about incentive trusts. First of all, we said disincentive, which is part of your trust. It disincentivizes people to do things that you don't agree with them and don't agree with them doing, is what I mean. So that'd be like drugs and alcohol. And maybe there's some behaviors that you just don't really appreciate because they're not supported. They don't support your values, and it's your money. It's all you've got. And when you're giving it away, you have absolutely every right, without hesitation. You have the right to control how that money is spent to the best you can. So why give it away to somebody that you know is going to spend it on something that you totally disagree with? Not a good idea. So control it. Next thing is an incentive trust. So the way that works is the opposite. It'll say there's money held in a fund. And let's say you say that money is available to the beneficiary when they're age 30. Okay. I started mine when it was 35, but age 30. And you say, but in the meantime, if you're not 30 yet, but you enroll in college, you get $1,000. If you finish your semester with B's, a B average and above or whatever, you get $1,000. And when you enroll the next semester, you get $1,000. When you graduate from college, you get $5,000. So you could do things like that Other things, that are really common is like a lot of self-employed parents will do this is they'll say, you can get, even though you're not old enough yet, say the restriction is 30 and you want to start a business, then you just show the trustee, hey, I want to start a business. Here's my idea. And I want to get money from my trust. And you can let them get advances on their next scheduled distribution. You can let them get an advance to start a business. And maybe it's going to be $10,000, $20,000, whatever you think is right. But those can be put in as an incentive. The other incentive is like to buy a home. Really common where the trust will say, you can have your total share free of the trust, like outright, if you're 35. If you're not 35 yet, then you have certain restrictions. You can get income, for certain things, but then you can make this incentive that says, and if you want to buy a house, you can get an early withdrawal of 50, 75, 100, whatever you want, $50,000. I've had some people put in 100,000, some people put in 10,000 in their incentive trust, but I think those are really cool. Other things like on handling distributions, these are other ideas. And you guys, if you want to talk about this stuff, and I can talk you through it, the pros and cons, I'm doing that pretty much every day. The benefits, some of you know exactly what you want. You just are waiting to kind of figure out who you want to have do your trust. I'm happy to do that. I'm happy to talk to you about this stuff. And the number is 855-500-TRUST. Make sure you mention the show, 855-500-TRUST. The other things like, what if you wanted to encourage good financial behavior? So you don't know, if you just give the money to the child, they, you just kind of hope that they do with it what you want them to do with it. I mean, that's one way. A lot of people do it like that. But you can do things like, in there, you say that the successor trustee is to keep the investments intact as the trustor, you left them when you died, and that you want them to be transferred in kind to the beneficiary. So they actually get the account as set up, and that encourages that beneficiary to just keep it going. I mean, it's really kind of a nice way to do it, because when you inherit money, a lot of people really flounder because obviously it's not money they've ever had before. Most of the time when they inherit money, it's more than they would ever have dreamed of ever having. And you kind of flounder trying to find a financial advisor and all that. So if you have your money that you're giving to your children, set up an account, put in the trust that they need to keep it in those accounts, to keep it intact, and use the same investment strategy. They could change it with time, but that gives them kind of a way to kind of move forward. Either that, or it's give them a bunch of cash and it just kind of melts away. You can, I've had some clients that do a lot of investing in promissory notes, and they required in their trust that the promissory notes be held on to for at least 5 years, after which time they can be sold. So that usually means that the trust is probably going to be kept open for those 5 years, working with the trustee, working with the beneficiary to make sure that the promissory notes are serviced properly by the beneficiary, which is really good training. You can encourage things like maintain the rental properties, establish your own trust before receiving an inheritance. I mean, that's one that I put in every trust, and I will talk to you about it. It says that any money from this trust that's going to a beneficiary, that money is to be put into a trust that is established by the beneficiary to be held as separate property. Now, this isn't to say we don't like your spouse, we don't want you to share with your spouse. We're simply saying, acknowledge, recognize, realize that inheritance is separate property. It's coming from your parents, your family, your bloodline, or from whoever's giving you the money, and they would prefer that you keep it as your own, separate, rather than commingle and all that. And that's the way most people are good with that. So we've been putting that provision in our trust for quite a while, and it seems to work out really well. Clients really, really like it, and their beneficiaries are obeying it. We've had clients pass away with that provision in there, and we just, the trustee says, nope, go get your own living trust set up. Doesn't matter who does it. Get somebody that knows what they're doing. Set up your trust, let us know, give us the name of it, and we will transfer your inheritance from mom and dad's trust directly to your trust. That's another good provision to encourage good financial behavior. The other one is you can build flexibility into your trust, because sometimes, things are they're different when you pass away. I was talking to a gal a couple of weeks ago where she paid like $20,000 for her house that today is worth, $850,000. So if she sold her house, she would have huge capital gains taxes because she can only exclude 250,000, even though it's her residence. But when she passes away, that money, that whole entire house will pass to her kids, to her beneficiaries, and there's no tax if they sold it after she passed away. So sometimes what we have to do in a trust is we have to build in powers, the authority, and give the successor trustee authority to do certain things. Like I always like to do my trust and say, well, the successor trustee has the power to take the deceased spouse unused exclusion amount and apply it to the surviving spouse's stuff. That's something that should be really in every trust. It's called the DUSA amount, DSUEA, because you can carry over a deceased spouse's exemption amount to the surviving spouse. That's a really big benefit when the surviving spouse goes to try to sell things later in estates that are fairly large. Large estates, we talk about, you can pass $12 million to your heirs without having any inheritance tax or any gift tax or anything. And most people just go, oh my gosh, that's an alarmingly high number. But that number is going away at the end of 2025. I mean, we're at the end, we're at the end of 2022. So we got, less than 3 years to go. And that number will be going away and it's going to drop down to 5 or 6 million, which is still a big number. But now we're getting into the range where you're going to have a lot of people's estates, especially if you have real property or business or something in California. The numbers they're very realistic. You're going to be bumping into those numbers. So you want to have flexibility built into the trust. You want to have the trustee have some flexibility to alter the terms of the trust if necessary. They can actually amend or alter the terms of the trust to adjust for tax consequences that we may not have anticipated when the trust was drafted. That's a really good thing to put in there. I like to put in the trust specifically that the trustee is to employ people to help him or her do their job. They are to employ a tax professional to do the tax returns. They are to employ an accountant to do the accounting or a bookkeeper. Either way, they're to employ appraisers, real estate professionals, lawyers, whatever needs to be done. They have the power to, and also the direction under California law to delegate duties that they are not professionals at. Okay, so if you're serving as a successor trustee and you're listening to this, you might be thinking, what is he talking about? What I mean is, if you're the successor trustee and you feel like you're doing a good job, congratulations, that's awesome. Not many people can do a good job because they don't know what they're doing. You can read books, you can go on YouTube, all that stuff, and some of that's going to be helpful, but did you get it done right? Okay. You may think that it's a good idea for you to prepare the tax return, like the 1041 for the estate for the first year. Well, if you're a professional, licensed tax professional, then you can, because you have a license to do it. But if you think you can do it because you do your own tax returns every year, now you want to do the one for your mom's trust, that's not a good idea. That's actually a breach of duty as the successor trustee. Your job is to be the successor trustee, and you don't have a license to prepare tax returns for other people. The trust is not considered family, it's considered other people. So you don't want to be doing a trust tax return if you're not a professional. So that's a required delegation of duty. You got to delegate it to somebody who's a tax professional. So just find somebody that's good at it. You don't have to worry about that kind of stuff. All right, so those are some of my ideas on handling distributions to trust. It's a good idea, I think, to have that conversation. I'm happy to have that with you and discuss it. Keep listening to this show. Give me a call, 855-500-TRUST, and we can go over it and see, what do you want to put in your trust? And some people want them to be really fancy. Sometimes it's fun to talk about how fancy they can get with all these incentives and disincentives. And some people go for it. I think most people want their trust to be fairly simple. They want to have that responsibility while they're still here, is to teach their kids how to manage money. And what I've seen is that when you have kids that are managing their money, they're doing a good job at it, then the parents are not restrictive in their distributions. They basically say, okay, divide it equally between my children, and they will take care of their children, and they will take care of what they need to. When you have children that didn't quite pick up the financial savvy, and you have some kids that are terrible at handling money, which happens more and more and more because we're not, kids are not that, they don't checkbooks anymore. They just they slide their plastic and hopefully it works. And I'm not trying to be degrading to them, but that's, I mean, let's face it, that's kind of the world we're in. People don't really know what's in the bank. You can look online or something like that, but most people are just like, tap, 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 pay this money. I think there's enough money in there, and then find out later that they've overdrawn. So I don't think you want that kind of, money going to kids. And I think as far as being responsible, I think you need to, if you have a kid that's really financially responsible, let them have the money. If you have one that just is really struggling, don't give them the money, because it's going to go to places that you would not approve of. So it's okay. It's your money. And I tell everyone this, and I will tell you that as well. It is your money. It is all you have. I mean, your trust estate, your money, it is everything. It doesn't matter how much it is. It's just 100%. It's everything. Whether it's a little or a lot, it doesn't matter. It's all you have. And so you want to do that wealth transfer to your kids and try to make it so that it's not stripped away by probate fees and costs, and it's not stripped away by time and by fighting and all that. You try to make it so that everything is as smooth as possible, so that you don't have all the costs and expenses of the fight and the battles and all that. And that's our job. I like to resolve people's problems before they come up. I like to make it so that there's smooth transition of wealth between parents and children. And that's our job. That's our goal. That's our goal here on this show. That's our goal at GQ Law. Give us a call. Be happy to help you out. 855-500-TRUST. Coming up next, you got Rich Mathurin, tax attorney from GQ Law, talking about taxes.
You've got questions. We've got answers. This is the Word on Wealth with Gary Quackenbush of GQ Law. Gary's here to give you peace of mind with expert estate planning, trust administration, inheritance, and probate. Call Gary to build, protect, and transfer your wealth. 855-500-TRUST. .com. .trust. GQlaw.com.
Go on. Hey, welcome to the Word on Wealth. This is Gary Quackenbush and Rich Mathurin of GQ Law. We're good to have you. Happy to have you along today. And I just want to make sure that you guys, if you want to give us a call to be part of the show and ask questions, the number is 888-344-1170, 888-344-1170. And that way you can get on the air and you can ask Rich and I any question you want. Might as well do it. 888-344-1170. Rich, thanks for being on the show with me again today. How you doing?
Great, Gary. Good to be here.
solving the world's tax problems?
One person at a time.
There you go. One person at a time. That's good. So we are in the thick of tax season. And I know a lot of this is kind of a repeat of stuff, but what would you tell somebody if they, they haven't done tax return, they haven't done their tax returns in a while. Now they're trying to figure out, what should I do? Should I do my taxes? If I do my taxes, the IRS is going to know how much I owe. And now they're going to be chasing me around. What would you advise somebody that hasn't filed their tax returns in a while?
I would definitely encourage them to get their taxes done. The IRS, if they get any type of income information for you, whether it be a W-2 or 1099, they are going to know that you earned income. And if you don't file your own return, they likely will prepare their own return for you and submit it. They will take your income information, give you the standard deduction, and then tax you at the highest rate. I have seen these what they call substitute for returns create tax balances that are double, 3-4 times as much as if you had your own tax preparer prepare them. So I would encourage you to get those done. Also, I think we've talked about this before. If you file and you have balances, there are solutions, whether it be a payment plan, an offer in compromise, a bankruptcy, currently not collectible status, but just totally ignoring it, it will catch up to you.
So Rich, let's say, I mean, the IRS, we know that during the pandemic, they've really kind of struggled. I know they keep kind of sending out their news that we're hiring 5,000 more people. And I mean, I would imagine that's probably really happening, although every business in the country right now is struggling to get employees. But does the IRS, I mean, are you seeing, do they really have time to go and do these substitute for returns? I mean, are they totally asleep now? Are they really pushing forward and finding people that haven't filed?
I have seen it picked up. I'm starting to get calls from local revenue officers again. So they're starting to pick back up. They're answering their phones. So that's a clear sign that they're back in business. And they're sending out notices. I just got through with one client, had about a stack of 30 of them. So they're back in business and they're going to start doing collections. It may take them some time, but again, they will eventually catch up to you, especially if that's low hanging fruit for them. When they get a W-2 or a 1099 and there's no tax return that they can match it to, then that sets them off. That's an automatic almost.
So with them, kind of getting back in, it seems like, I know you've seen this where, prior to, a couple of years ago, they were kind of getting chased around by the IRS. You set up a payment plan. I mean, it used to be, I know in the old days, it used to be like, 5 or 6 years ago, we'd set up a payment plan. And if somebody defaulted, they're not making their payments, they get all these notices and then the IRS would really be hammering them. But then during the pandemic, it seemed like a lot of people were just kind of skating. They weren't making their payments. They're just kind of skating. They're kind of like waiting, I think I'm going to wait, see what happens, let sleeping dogs lie. And I think the message that we're kind of getting from what you're saying today and what we're seeing is that we've let sleeping dogs lie, but the problem is the sleeping dogs are now awakening.
Yeah. The one client that I just mentioned, that was the notice, the intent to terminate their installment agreement because they hadn't been making payments during the pandemic. I've seen that in several cases. The IRS was, for a couple of years, they weren't too aggressive. If you didn't pay, they didn't send out notices and stuff like that. But now I'm starting to see, we haven't gotten a payment from you since September, so we're gonna terminate your installment agreement unless you make arrangements to get current immediately.
You're listening to Rich Mathurin, attorney with GQ Law. We're talking about tax situations. It's during tax time. It's kind of an appropriate time. Rich is on every Monday with me on the show. I'm talking about taxes. When you owe money, what do you do? What are some options? Is there anything you can do? So Rich, I think
I wanted to mention 2 other benefits for getting into an installment agreement is the interest rate that you're charged gets halved automatically. Plus, if you can get your balance down below 25,000, any liens that they might have against your house or your personal property, those would be released upon 3 payments under the installment agreement. So there's a lot of benefits to getting into an installment. If you can't pay your installment agreement payments, my suggestion is contact me and let me know, then we probably can get you into a non-collectible status. That's where the IRS, you do have to show your financials, but if the IRS sees that you don't have the ability to afford your current installment agreement, they would either probably lower it or maybe put you into a non-collectible status, which is probably the best status you can be in because they don't do any active collections on you. Plus the statute of limitations on your balances continues to run.
So like right now, it seems like if the IRS is starting to come forward, don't sit back and wait for them to get your bank account. Don't sit back and wait for them to come after your wages, but move forward. So would you say then really kind of now we know the IRS is, they're getting their machine going again. It's like, if you used to owe and you haven't heard from them, like get on it. I mean, is there, I'm assuming that's your recommendation. That's what I hear. But then if somebody then was like, well, before the pandemic, I was in a payment plan. It's been really quiet. I don't know what's going on or how much I owe. Is there a way that you can actually figure out where they are in the collection process and how much they owe?
Yes, we have tax software. We get a IRS power of attorney. And once that's approved, we can run their tax report that shows all the balances owing, whether they filed for a year or not, whether there's a substitute for return, whether that individual's year is in collections, whether there's been a lien filed for that particular year, all your payment history, your interest and penalties, whether you might be able to for a discharge in a bankruptcy for some of the taxes, when your collection statute end date, the statute of limitations, when for each balance, when that might fall off. That might be a factor for somebody. If you have a couple of months to go, you might slip through the cracks and your balances might fall off under the statute, but you need to know that, because if you think it's going to fall off next year and it actually has another 3 years to run, they will catch up to you.
So then with this report, is there a risk that if somebody like goes and gets the report, and I know that requires a power of attorney that we have to post and then we get the report, is there a big risk that there's some flag the IRS will all of a sudden see, oh my gosh, they're checking their report, let's go and do these levies?
No, that's totally a separate issue. That the thing that's going to set the IRS off is if they get notification of your income through a W-2, a 1099, maybe a mortgage interest statement, and your balances type of thing. If you have a high balance and you're farmed out to a local revenue officer, they will be on your case pretty quickly.
But as far as somebody moving forward and it seems to me, if it makes sense, is that it would seem to me like if you're moving forward, you're trying to get information on your account and you're actually kind of trying to take these steps to resolve things. That's not something the IRS is going to punish. If anything, it would be like this person's maybe moving forward, maybe you're going to get it resolved.
Well, one thing, if we get a power of attorney for you, then they're going to contact us, not the client. So that's another thing, not having the IRS call you at home or
at
work or whatever,
on your cell phone,
on your cell phone, that has a lot of advantages, so you can sleep at night. Somebody else is dealing with it, and helping you on this.
That's true. We've always said, you do your job, we'll do our job. It's how many times do you hear somebody, even when we're talking to somebody, we'll be on the phone talking about their situation. They go, oh, I got to go. My boss is here, or my lunch is over. Or let me go outside. So nobody, but and to try to deal with that with the revenue officer who isn't as nice as us, saying, oh, that's okay, we'll call you back later. The revenue officer, that's okay, I'll take your bank account tomorrow. But 855-500-TRUST is the number. If you want some help with this, you can talk to Rich or I about your tax situation. If it's you or a friend, get these things resolved, get them fixed, get them out of the way. And if you get ahead of it, it's just a lot easier if you're prepared and get ahead of it. That way you're not fighting, they've got your bank account already. They're already got their hooks into your wages. When you get to that point, you can still resolve it. It's just that it seems like it's just better to get ahead of it. If you know or suspect you have a tax problem, or you just don't know, you just haven't filed in forever, then get this report. What you do is call 855-500-TRUST. Rich can get the report. We'll talk to you about, how all that works. We'll give you your options, the cost of it and how long it's going to take, what your requirements are. And then you can figure out where you stand with the IRS and do that before things get bad.
Yeah, and definitely. And I would also mention that, when they have been down a little bit dormant, they are more, I have gotten better partial payment installment
Interesting.
agreements. So, you might get a better payment plan than if things are back up and running and you're running at full speed, then the IRS might want a higher payment plan.
Interesting. So that's the deal, you guys. You're here on the listening and heard that here on the Word on Wealth. We've got Rich Mathurin, attorney with GQ Law, talking about how to resolve tax situations. If you owe money, if you suspect you owe, he can get you a report that will tell you where you are with like tax return filings, if you haven't filed in a while, or if you wonder how much money you made because you lost your W-2, your 1099, your 1098 INT, whatever, that stuff that can be obtained, usually from the IRS, and we can do that. So give us a call, 855-500-TRUST, ask for an appointment with Rich, and we can get you set up so we can take care of your tax situations. All right, you're listening to The Word on Wealth with Rich Mathurin and Gary Quackenbush. We're going to be back, and we're going to talk about some other ideas, what happens with the IRS when you owe.
You don't need to know everything. You just need to know where to find answers you can trust when you need them. Welcome to the Word on Wealth with Gary Quackenbush. We're here to help you build, protect, and transfer everything you've worked hard for with expert estate planning, trust administration, inheritance, and probate. Call Gary and the team at gqlaw.com, 855-500-TRUST.
So Gary, we've talked a long time about estate administration. So what is that and why is it important?
Estate administration is the distribution part of estate planning. So when someone passes away and they leave money to beneficiaries, the property has to be administered. So it's like taking it from the decedent to the survivor. That's called the estate administration process. So usually you're going to have a successor trustee that's named in the trust. So have no idea what they're doing because they've never done it before. So then they call on GQ Law and we
You have a call, Frank from Normal Heights.
give the name again. Full and good.
Call 855-500-TRUST or go online and download Gary's free ebooks and videos. Read Gary's blogs. Call or click to request your free consultation or to talk with a member of the GQ team. That's gqlaw.com, 855-500.
Hey, welcome to the Word on Wealth. We have a caller, Frank from Normal Heights. Thanks for joining the show. Welcome to the Word on Wealth with Rich Mathurin and Gary Quackenbush. How can we help you?
Yes, I thank you for your concern and interest in helping folks with their tax issues. There are some other ways to think about things, and I wonder if you're open to a comment about the idea of perhaps expending energy in a direction that'll be even more helpful for the folks.
Well, that sounds intriguing. So what, I guess, yeah.
In your practice, and as I understand it, yes, sir.
Yeah, no, I'm just kind of curious. Yeah, we've been going through some of the options. Do you have a particular situation, or what's your suggestion?
Well, the suggestion is that if we examine the Constitution, and particularly Article 6, we see that the Constitution and the laws of the United States in pursuance thereof shall be the supreme law of the land, and that all judges shall be bound thereby, and all legislators, and executive and judicial officials must swear an oath to support the Constitution. And when we read the text of the Constitution, we see no provision for the application of an IRS, a
Oh, I see
direct
what you're
tax
saying.
upon the people.
You know, it's interesting. So that's, and I understand where you're going. Believe me, I've done this for a long time.
Well,
But that's like, but that's,
there's further down that road, and specifically, when
yeah,
we
but
talk
but
about
I
the
don't,
laws of the
the
United
thing is,
States,
I think
there's
what,
something called deprivation of rights under color of law.
yeah,
in
but
18
but
U.S.
Frank, if you, okay, I don't, that's not something I want to get to on the show. We're talking about you legitimately filing your tax returns and all that. So I appreciate you calling on that type of thing, but I don't want to talk about tax protest on the show. But I appreciate you, and I'm glad you have your opinion. I'm glad we're in America and everybody's entitled to it. So thanks for calling, Frank. Appreciate that. All right. Thanks, Frank. All right. Welcome to Word on Wealth. You got Rich Mathurin and Gary Quackenbush. We're talking about different ways of kind of working through your tax situation. And I don't want to talk about protesting or getting, pushing back and saying the Constitution says there's no IRS and there's no taxes. Those are arguments that, I've been all over those with the U.S. government and all that. And yeah, I guess you can take one way or the other, but what I prefer to do is help people figure out ways if they've got a tax situation and they've already elected to be in the tax system, like most of us, then how do you resolve that? So if you want to call, contribute to the show, you have a question for Rich or me, give us a call at 888-344-1170, 888-344-1170. So Rich, let's see. So the other thing we wanted to talk about, Rich, is sometimes people get a notice in the mail and the notice will say like, your return has been selected for examination, call this number. What happens when the IRS does an audit? I mean, because my thing is like, I think people get that and they go, oh my gosh, I need to hire an attorney right away. If they get a notice of audit or notice they're being examined, what happens with that process? Does that mean like they're immediately thrown into an audit, or how does that work?
There's three types of audits that you would hear. There would be a correspondence audit. That would be just getting a letter and probably providing some type of information that they're unclear on. That's probably the least difficult one to deal with, not it. And the second one would be an office audit, where you would go to the IRS office and you would speak with the auditor, and they might ask you to bring some records. And then the third one would be a field audit, where they actually come out to usually your business, and they do an audit there, and they can ask for demand records. That's the most difficult one. And I think, especially for that one, you should have some type of representation, because, they can review your documents, and, that's where we get into possible fraud and things like that, that they want to see more, that there's something that's really piqued their interest, whether they get additional information that doesn't match what your tax filing is. So those are the most severe.
Interesting. And talking with the different audits, like we're going through, we started out the show talking about the substitute for return, where the IRS gets our information. And it's like, if you don't file a return and the IRS finds information on you, and then they say, we're going to file a return based on this information, that's technically, it's kind of an audit. It's like you didn't file a return, and so they're going to put numbers on it. And I always look at that like, well, that's kind of an audit before you actually file. And then you file a return, and the IRS is kind of doing the same thing. Like, hey, we think you've missed some numbers because we show 1099.
Caller Leanne.
And they show like, we have these different records and we want to compare them. So you end up getting into an audit. But I do like the idea of getting, at least a consultation to figure it out. So it looks like we have another caller we're going to take. Welcome to the Word on Wealth. Who's speaking?
Hear me?
Yeah. What's your name?
My name's Leanne.
Hi, Leanne. Welcome to the Word on Wealth with Gary Quackenbush and Rich Mathurin. How can we help you?
Thank you. It's my first time listening and appreciate the things you guys have been sharing. And my question is more about a trust,
Okay.
I guess, if that's okay. So my mom and dad had set up a trust, and he passed, my stepdad, he passed away probably 7 years ago now. And so we're looking at the existing trust, and she really wants to make sure. So he had 2 kids and she had 3. And so she wants to make sure. We talked to one attorney who had said, you know, you can split this trust so that there's a separate trust for my mom's current situation going forward that would only be for her kids.
Mm-hmm.
Do you understand what I'm saying? So he's saying we have a couple options whether to do a whole nother separate trust for where she is now with just her 3 kids, or to do it within the existing trust. I just wondered if you had any thoughts on that.
Well, sure. And that's a great question. It's something that's pretty typical. Let me ask. So your mom and stepdad are both still alive?
No, my stepdad passed away probably about 7 years ago now.
Okay.
6 years ago now.
And then before he passed away, so your mom and him had they have today, I guess, a joint trust, and that's what her assets are in now?
Yeah.
Okay. Yeah, because
Well, she sold the 2 houses that they had, and she had enough cash. She bought another house with the cash that she had, and now she has, you know, some of the money in one account, which was the account that's still in the trust, but the rest of it's kind of just sitting out there, not anywhere right now. So you need to figure that out.
Now, did when he passed away 7 years ago, was there any legal action that was taken to reset the trust or split the trust or create, like they call it, a A trust and a B trust? Do you know if anything like that happened back when your stepdad passed away?
Well, that was the suggestion that we got from someone that we saw about a year ago. We haven't done anything specifically with it. I'm the trust. I will be the trustee once she passes away. But
okay.
So yeah, we weren't sure if we should just do that, split the trust like an A/B trust, or do a whole new separate trust. I guess is my main question.
Well, you have kind of, and this is really a good question, and it's let me try to just simplify it to kind of give you at least a start on what to think about. So you have 2 different situations. One is when your stepdad passed, what did the trust say was supposed to have been done at the first death? Because depending on how the trusts are set up, some of them will say on the first death, do this, you know, and then on the second death, do this. Other trusts, even though, you know, I mean, and without reading the trust, obviously we don't know, but some trusts don't say anything as far as their first or second death. It says, you know, when they're both alive, they both get money from the trust. If one of them is alive, then the remainder is the trustee and they get the money from the trust. So sometimes at the first death, there's no action that needs to be taken depending on what the trust document says. Okay. So there's kind of a question on whether, you know, what was your mom's, what was your stepdad's, and then, you know, selling the 2 properties is part of that. Your stepdad's money that's supposed to go to his kids. And it's really kind of depending on what was supposed to have happened and who's supposed to benefit.
Yeah, everything was together. And the lawyer we did talk to, he did say, you know, that we could put it into the A/B trust. There was something in there that he read that said we would be able to do that. And that we would just need to put the new house into the B trust, or whichever trust would be just for my brothers. But before that, it was everything, you know, if they both died at the same time, you just sell everything and split it evenly among the 5 kids, or then to the grandkids. But, you know, she gets a considerable amount of money every month. She's this other new house that's completely paid for. And then she sold the other 2 properties. So,
okay. Well, I think a lot of it, Leanne, a lot of it is going to be kind of accounting to see what should kind of be happening from the first trust like split. And you got to be kind of careful that if there's money that should have been put into like a separate trust, that we need to account for that. because it's going to be the 5 kids. There's going to be issues between the 5 kids, like how much is supposed to go to his kids and how much to your mom's kids. And then where is that money now? So I think it's something I'd be happy to talk through that and kind of see where we are and give some suggestions. But part of it is going to be definitely a new trust for your mom moving forward. And part of it is going to be resolving what happened or should have been happening over the past 7 years with the trust. It's a little complicated, but it's something we can deal with. If you want to give us a call, I mean, I'd be happy to give you a free consultation on it.
Are you in the San Diego County area?
Yeah, San Diego County. Yep.
Okay.
All right,
yeah,
Leanne, thanks for calling. Thanks for being part of the Word on Wealth.
Tell
Everybody,
a
we'll
friend
talk to
about
you
the
tomorrow.
Word on Wealth, featured since 1995. With financial solutions attorney Gary Quackenbush, an expert in estate planning, wills and trusts, and tax problem solving. Gary is past president of the California Society of Tax Consultants. Reach out to us. The Word on Wealth team of financial experts is here to answer your questions and help. The information you hear on the Word on Wealth is for general information purposes only. This program discusses general
Oh, she didn't tell me she wanted to talk about trust, so I didn't know.
individual
okay.
legal needs. The opinions expressed here do not necessarily represent the views of Salem Media Group or its sponsors. The Word on Wealth